This is Andrew Stotts, and I'm going to explain the changes in the Chinese banking system when the government changed the loan-to-deposit ratio and removed the cap of 75%, which just recently happened. Let's look at this is a balance sheet example of the top 4 banks in China, and what we can see is that the funding for these banks comes from deposits. So about 75% of the money that comes into the banking system comes from customer deposits. There are other sources of funds such as borrowings and equity, which the shareholders put in. What the Chinese government's regulation in the past meant is that not all of these deposits could be used as loans. In fact, of total assets of the banks, only about 50% were loans. Another 25% were bonds. Then there's cash and other items that make up the rest of the balance sheet of the Chinese banks. When the government changed the regulation, what it meant and what it means is that instead of having this portion of bonds, this amount, let's say, can now be also given as loans. So we could get to almost 75% deposits, 75% of assets as deposits, and 75% of assets as loans. This would be a 100% loan-to-deposit ratio and is not unusual in the banking system. But the main thing about this is that who borrows bonds, who issues bonds? It's large banks and large corporations. When the government changed this regulation, what it now means is that this amount right here can now be lent out to companies and individuals. And what this is doing in China is trying to encourage more lending out into the general economy to support businesses and people that are potentially struggling right now due to a falling stock market and a slowing economy. So it's a step that makes sense. A 75% cap on loan-to-deposit ratio is a bit restrictive, and this should allow the banks to inject liquidity into smaller, mid-sized companies and individuals.